Bulls are charging into the new year. Signs of a soft landing for the U.S. economy have pushed the S&P 500 index up nearly 23% this year, with more strategists optimistic over the Federal Reserve's dovish forecast on interest rates next year. But is it too early to be this bullish? Our next guest doesn't think so. He sees the S&P hitting a new high at 5,500 by year-end 2024. Joining us to break down the market outlook in the year ahead, we've got here on set with us Jay Hatfield, Infrastructure Capital Advisor, CEO, and Yahoo Finance reporter Madison Mills, also joining as part of Yahoo Finance's 2024 Investor Guide. Jay, great to have you here on set with us. First and foremost, what is the biggest risk to your outlook here?
Thanks, Brad and Shauna, for having me on in studio. Well, if you really track back to what our non-consensus call was, we had a 4,500 target, which is actually more bold than our 5,500 relative to what all the other strategies are at, and really focuses on Europe. Most U.S. investors, rightly so for equities, don't focus on Europe, but we're fixed income investors primarily. And Europe is in a recession. They have a GDP now, which you can access on the web. They're tracking negative 1.6% this quarter. They were negative 0.4 really, if you annualize it last quarter. And so we think the ECB is going to be forced to cut first, which will give the U.S. Federal Reserve cover. And in fact, if you look at the futures market globally, every OECD country is projected by the futures market, not us, to cut rates by an average of over 150 basis points. So it's really more of a global focus, because I am nervous. You saw some Fed officials about the Fed. They are still in their Phillips curve mentality that we have to have a recession to eliminate inflation. But that's really the heart. So I would urge your viewers to focus on Europe and see when the ECB cuts, because they're probably going to be first.
Yeah, Jay, I wanted to bring up the whole aspect of rate cuts and how much of your call really hinges on that, because like you just alluded to, we heard from Austin Goolsbee, who was out making comments over the weekend, just saying that it is still too early to really call a victory here in the fight to tame inflation just a little bit. What are you forecasting in terms of that more aggressive outlook that you have for next year? I know a lot of it depends on what we see internationally, but how much of that, I guess, is factored in terms of Fed rate cuts and what exactly that looks like?
Well, that's a spectacular question, because you should never quote multiples without talking about interest rates. So we have a discounted cash flow multiple, and so roughly every 25 basis points is a full S&P multiple. So we're forecasting 3.5% on the U.S. 10-year. So what's great about our simple model is you can say, oh, well, I don't believe that. I think it's going to be 4. Well, then you take 2 multiple points out, which is roughly 500 points. So you could get down below, actually, those targets you just put up there. So it is really based on an optimistic view on interest rates, but that has been unfolding. And like I said, now it's actually consensus we're going to have cuts. It's not 2 months ago we were saying Europe was going in recession and there were no expectations. Now it's really globally. So if that unfolds, then our case is likely, and I would say the risk is to the upside on our case because of a potential AI overvaluation. So you could get 21, 22, 23 times, assuming rates are, or in fact rates could go to 3 even if we do have global rate cuts.